Hello, my name is Mark Richardson, and as Chris has so eloquently said, I've spent the last 20 odd years in private equity, which makes me a water buffalo. Thanks, Chris, for that. I think your presentation was absolutely fantastic, and everything I'm going to say in the next 10 minutes or so is pretty much on track with the key messages that you've already given, with less photographs, I might add. If we think about private equity, it's very important to understand how the investors who put their capital into a private equity fund are looking at that asset allocation. Most private equity investors are professional institutions. Usually they're pension funds, or they're wealth managers, or they are fund of funds. But whatever their category of investment institution that they have a portfolio which consists of cash, fixed income, real assets like property and infrastructure, listed equities, and of course, private equity. And as you can see on this very simplified risk versus return chart, the private equity firm is looking for a higher return than it can get by simply putting its capital into the stock market of whatever country they are invested in. Venture capital is looking for an even higher return. And when we're talking about returns, let's be real here. Private equity wants to make between 2.5 and 3.5 times its equity investment at an internal rate of return of at least 25% over a 3, 4, or 5 year period. Those are the numbers that if you're looking for capital, you've got to be able to demonstrate to the private equity firm that the investment they make in your company can deliver that kind of return. Which is why, of course, we need to look at what a private equity firm actually needs to do to achieve that. Well, the first thing they need to do is raise a fund. And we're not going to spend too much time on that, but it is a very complicated and time-consuming exercise. Once they've raised a fund, they need to buy companies. Now, you'll hear all sorts of words around investments and partnering and sharing future opportunities. But the reality is a private equity firm wants to buy a company. Now, it might buy a minority part of that company, your company, or in the vast majority of cases, it'll want to buy more than 50% to be able to control the future of that business over the next 3, 4, 5, or 6 years. Now, believe it or not, the private equity firm has to create value over that period of time. You can't just sit there and watch the company grow or not grow. Pardon me, a bit of a frog in the throat there. And eventually, of course, in order to return the profits of the investment to the underlying investors in the fund, they want to sell the company. That whole journey between buying the company, creating value, and selling the company is that 3, 4, or 5 year time frame that Chris was discussing earlier today. Let's have a look then at the kind of private equity firms that you're most likely to run into. And literally, they're small, medium, large, or very large. And I think the vast majority of people on this call will only really be able to access a meeting with the small end of the private equity segment. Now, small doesn't mean small the way you and I think about it. It means anything up to perhaps $100 million of enterprise value. And if we have a look at the kind of private equity firms that this relates to, then we are looking at businesses that have established funds along the lines of this chart here. The smaller firms are always called growth and expansion funds, and that was my first fund, which was $110 million. And that meant that we could make investments into businesses with a value of roughly between 50 and 75 million. Our second fund was $250 million, and that meant that we could make investments into businesses worth more than 50 or 75 million, perhaps up to a maximum of 150 million. But nevertheless, we were in the growth and expansion fund space. That's the only kind of fund that will do a minority investment. So if you're listening to this and you're thinking you want to get a minority investor into your business, you're wasting your time to go to the global private equity funds or the large-scale domestic buyout fund or the medium-scale buyout fund. You've got to go to a fund which makes it very clear that they'll take a minority position. On the other hand, if your business has developed well enough and you want to sell 50 or 60%, then there's a plethora of different funds that you can go to. It's critical to understand the investment strategy of any particular private equity fund that you go to. They'll always take a meeting, always. But a lot of times they know before they've even started the meeting that they're not interested in making an investment into that particular company, but they are interested in the segment or the intellectual property that they can gain from the meeting. And Chris is quite right. You've got to kiss an awful lot of frogs before you find Prince Charming. So what happens inside a private equity firm? Well, literally, the advisors or the bankers or the owners bring approximately 2 companies a week, sometimes 3 a week, to the private equity firm. So there's 100, maybe even 120 investment opportunities presented to the deal team every single year. And out of those 100 opportunities, any particular private equity firm only wants to do 1, 2, or an absolute maximum 3 investments a year. The reason for that is quite simple. There's a huge amount of time and energy spent on due diligence and looking at the business from an investor's perspective. This chart is pretty much everything I want you to take away from this presentation. We're going to spend 3 or 4 minutes on this specific initial evaluation template. And if you would like to access this chart, I'm sure that we can arrange for you to have the slide post this webinar. What you'll see here is a simplified version. I know it looks complex, but it's a simplified version of what a private equity firm looks at prior to making an investment decision. And I just want to orient you to it. There are obviously 6 components here. There's the product or service to market. There's the leadership team. There's the strategy and financials. There's the competitive position. There's the risks within the business. And finally, there's the ability to attract capital. And the red, the orange, and the green, I hope, are pretty self-evident. But if we take the very first bullet point, demonstrated market need and acceptance under the product or service to market, is that unclear? Is it plausible? Or is it 100% believable? Literally, this chart is used, or a version of this chart, by every private equity firm after the initial meeting with the potential company or investment that they can make. So the more you understand that you have got these items complete, the more likely it is that you'll get through that first meeting and get to the second meeting and the third meeting and the fourth meeting and the fifth meeting, and with luck, get an investment into your business. Within this template, though, there are 2 or 3 things which are just not negotiable. So let's have a look at strategy and financials on the top right. For any private equity firm, and I am distinguishing between private equity and venture capital, the financials are critical. It's absolutely a requirement that you can present a forecast over that 3 to 5 year future period of each of the fundamental elements of the financial performance of the business. So sales and revenue, gross margin, a full profit and loss projection, a full cash flow projection, and a full balance sheet projection. And obviously, the private equity firm will want to look at the last 2, 3, or 4 years of financial performance on the assumption that you've got 2, 3, or 4 years of financial performance. If you're in the startup phase or the early stage phase, then frankly, private equity is not for you. Venture capital is, and also private debt. And private debt is a massively growing segment of the market. And I'll talk about that in just 1 second. When all is said and done, if there's a lot of green ticks on this chart and not too many orange ticks and not too many red ticks, then the private equity firm will go forward with the evaluation of the investment opportunity into your business. And what they're looking for is only two things. So go to the bottom right of this chart and look at the ability to attract capital. And here is the sort of bottom line. The business has to have the potential to exceed 30% internal rate of return, and it has to have the scope to generate 3 times the capital invested in that 3 to 5 year time frame. Countless businesses are looked at which get through the first initial excitement stage, but then when the deal team within the private equity firm runs its analysis, the mathematics and the financial spreadsheets don't demonstrate those potentials. And so the business is not invested in. I do want to make this 100% clear. Not every private equity investment makes 3 times or 30% internal rate of return, but those are the goalposts that the private equity firm have pretty much promised their investors they'll aim for, and they're trying to achieve it. With this chart, you can actually do the work the private equity firm is going to do before you have the meeting. And if you tick your business with too many reds and too many oranges, don't bother taking the meeting. It's just going to be embarrassing for you. Make sure that all of the aspects which are on this single slide, you've got under control to some extent or other. And again, I emphasize, it's not easy to do this. You know, if you're in a startup or small scale business, you know, you're working 24/7. It's not easy to write the proper documentation and the proper presentations that would demonstrate that you've got this all under control. In terms of the magic, the secret sauce behind any successful investment, it is the leadership team. The rest of the elements on this chart can be ascribed to the CEO, might be the founder, might not be the founder, might be the owner, might not be the owner, but the CEO, or if you like, the general manager, has to have absolutely unequivocally tremendous experience within this particular type of business and needs to stand out as what I would call a world-class CEO. There you are, an awful lot of things to have a look at, but that's the whole point. You want to be the 1 or 2 out of 100 companies that the private equity firm looks at that gets invested in. And by private equity firm, remember, you could be talking to venture capital, or you could be talking to private debt. You could also be talking to family and friends or angel investors. And every single one of those investors will have a version of this kind of business evaluation template. Let's assume that you do have EBITDA. And why is this written in such huge letters? It's because that's the only form of profit that the private equity world takes any notice of. You can't spend EBITDA. It's a false financial aspect of a business, earnings before interest, taxes, depreciation, and amortization. But I promise you, that's it, that the whole industry works on the basis of the company is worth whatever the EBITDA is times a multiple. In the venture capital world, that's different. You know, everybody looks at the future cash flow projections of the business. They then discount them by a very significant amount. But EBITDA in the private equity world is pretty much everything. If you don't have EBITDA, don't bother going to private equity. You might be able to get some private debt into your business, which is useful, and you might be able to get some venture capital into your business. If you think talking to a private equity firm is tricky, you should try talking to a venture capital firm. That's even harder. But on the other hand, they need to take more risks. So EBITDA is the profit indication that the whole private equity industry works on. And in order to prove up the EBITDA projections going forward, the private equity firm will allocate a deal team to this potential investment, and they'll do strategic or business or commercial due diligence, legal, accounting, environmental and social governance due diligence, and asset appraisals. And each one of those aspects of due diligence will be performed by an independent consultant that the private equity firm has appointed. So they're spending a lot of money. In a small-ish investment, a private equity firm might spend $500,000 on this kind of due diligence. At most of our investments, we spent well over $1 million for every investment we made on external due diligence. So you can't afford to do that unless the business looks like a very compelling investment opportunity, which is precisely why you see 100 companies in a year. You do that business initial evaluation, which I've just shown you, and then if it passes muster, you get into spending serious money and serious time. When I say time, it would be remarkably quick for a private equity firm to make an investment into your company in anything less than 3 months, remarkably quick. And more likely, it's going to be 3 months to 6 months, maybe even 9 months, maybe even a year for the private equity firm to get 100% comfortable about making the investment into whatever firm it is that they're looking at. Once they've made that investment, they have to create value. Now, in the interest of time, I'm just going to leave it at the point here, which is that the CEO actually is the person that drives the value in the company, and the private equity firm's job is to provide that CEO with strategic guidance, operational performance improvement suggestions, definitely acquisitions. Most private equity investments have some form of acquisition strategy to create value, and possibly enlarging the geographical footprint. Now, that's a very simple description of how a PE firm works with the CEO to create value. A far more compelling description is on this chart here, which, as you can see, consists of 4 separate areas: strategy and key performance goals, working with the C-suite, the management team and people, using all forms of capital wisely, and crucially, enhancing the board governance and operational guidance within the business. Once that's all settled and done, and there's an awful lot of work in that, of course, the time will come when the private equity firm wants to actually sell the company if it's bought the whole company, or sell its share of the company if it's bought a minority position. And the reason for that's obvious. Behind the private equity firm are the investors that put their capital into that particular fund, and they're looking for that 20, 25, 30% internal rate of return, and that 2 to 3 or even higher multiple of the capital that they've put into the fund. And that can only be achieved by actually selling the companies. So you've got to be aware that 3, 4, 5 years after the PE firm has made an investment into your company, they'll be looking to do a trade sale or a secondary sale, which is simply selling it to another private equity firm, or an initial public offering. They also quite often end up selling it back to you because their business has done so well. There's an opportunity for the prior owner of the business to buy it back from the private equity firm. At that point, I'm going to stop. A lot of information there. I apologize for the fact that this is recorded and I'm not able to answer your questions in live time, but hopefully that's been useful.